Okay, buckle up everyone. Wealth Investopia here, and we're diving into some stock picks for February 2025 that you absolutely need to know about. But before we get started, huge favor, smash that like button, subscribe to the channel, and let's get this money train rolling. Okay, disclaimer time. This isn't financial advice. Do your own research. I'm just sharing what I'm looking at. So, we've just wrapped up a pretty good year for the S&P 500, but new year, new plays. January is traditionally a solid month for the market, but things can get a bit bumpy in February. So, we're focusing on some smart buys right now to stay ahead of the curve. We're looking at a mix of growth stocks and dividend-paying stocks. Let's get into it. Stock number 1, Salesforce, CRM. First up, we have Salesforce, ticker CRM. This is an AI powerhouse. Think of Salesforce as the brain behind a lot of businesses' customer interactions. They're a software company diving headfirst into AI. And AI, my friends, is going to be huge in 2025. Not only will it fuel their growth, but it'll also boost their profit margins, something investors love to see. Current status: they've got a $327 billion market cap, and their stock has jumped almost 30% in the last year. Analyst buzz. Analysts are singing their praises, with a 12-month price target around $400, suggesting a 20% upside. Some, like Dan Ives from Wedbush, even see it reaching $425. Margin magic. This is where it gets really exciting. Their operating margins have shot up from single digits to a whopping 17%. They're also killing it with their earnings, exceeding prior targets and predictions. Valuation. Here's the deal. They're expected to make $11.22 per share in 2025. That puts their forward PE ratio at 30.5, which is below their 5-year average. It's like getting a discount on a high-quality product. They're also trading at their lowest valuation in a decade. This is why, to me, Salesforce is a no-brainer. Why it matters. Salesforce is constantly making moves and is making amazing partnerships to push that growth further. Stock number 2, Generac, GNRC. Next up, we're talking Generac, ticker GNRC, a major player in generator manufacturing. Think power backups. With crazy weather events happening more often, having a generator is becoming less of a luxury and more of a necessity. Recent dip. Their stock hit a high near $200 in November, but has now dropped to the 150s, a 20% drop in a short period of time. Market cap of $9 billion. The company has a market cap of $9 billion and has gone up 20% in the past 12 months. Analyst outlook. Analysts see a 12-month price target near $180 a share, implying a 15% jump from current prices. Pandemic. Boom. During the pandemic, they saw record sales as people flocked to generators. Cash is king. Now, even after the pandemic, their free cash flow is at record levels, like a money-printing machine. Gross margin percentages are also near record levels. Valuation. Looking forward, they are looking at 2025 EPS of 8.29, giving the company a forward PE multiple of 18.8 times, which is well below their average. The bottom line, the stock is also undervalued at what it is currently trading at. Generac has been on my watch list for some time and now seems like the perfect time. Stock number 3, VICI Properties, VICI. Now, let's switch gears to a dividend play. VICI Properties, VICI. VICI is a REIT, Real Estate Investment Trust. Think of them as landlords. They're the biggest landlord on the Las Vegas Strip. Think Caesars Palace, MGM Grand, you name it. They probably own it. REIT. Sell-off. REITs in general have been under pressure lately because of the Fed interest rate hikes, but that just creates an opportunity. Strategy. I'm focused on quality REITs, and VICI is top of my list. Recent drop. VICI stock has dropped 10% in the last 12 months, creating an opportunity to buy at the bottom. Solid business. VICI has a great management team and owns properties that are always generating money and will do well in any kind of economy. The VICI advantage. Remember, VICI doesn't run the casinos. they just own the real estate. They have the best operators. Dividend play. VICI is a REIT, so this is a stock I have in my portfolio for the long run. Buying opportunity. We saw a buying opportunity back in late August, and it's here again, which makes this another opportunity to buy in the dip. We have a real estate company that's been quietly crushing it, and that company is VICI Properties. Now you might be thinking, real estate? That's not very exciting. But stick with me here. VICI is special because they own casinos and resorts. Think Las Vegas Giants. And get this. During the pandemic, when other real estate companies were struggling to collect rent payments, VICI was consistently getting 100% of theirs. Let that sink in, okay? We're talking about a company like Really Income that saw payment go down to 50%. Just imagine if you were supposed to get $100, you only got 50. Meanwhile, VICI got every last cent. This tells you something about the quality of their tenants. They aren't relying on them to have record-breaking months. They just need them to operate consistently to make the rent payment. Analysts are reiterating the stock as a strong buy with a 12-month price target of nearly $35. That's over a 20% gain from where it is today. Plus, they've got a nearly 6% annual dividend, so you're getting growth and income. It's the best of both worlds. And to top it off, VICI has increased their dividend payout every single year since they went public. A company that's confident enough to hand out more cash each year shows that they are doing something right. When it comes to valuing this stock, we want to skip talking about how much they make, and instead we will look at something called AFFO, which stands for Adjusted Funds from Operations. It's essentially the cash they generate from their operations. Experts are projecting that in 2025, they will generate 2.32 in AFFO. Now, if we look at the price of the stock, it means we're getting a forward price to AFFO of just 12.5 times. Think of it like buying something at a discount. Their 5-year average is more like 16.3 times, so this looks like it is criminally cheap. Stock number 4, Qualcomm. Okay, next up we're shifting gears because we're going to the tech world. And it's time to talk about Qualcomm, ticker symbol QCOM. Now, Qualcomm is a semiconductor company, which basically means they make the brains that power our smartphones. A lot of other semiconductor stocks, like Nvidia, have been on an absolute tear lately, but Qualcomm has been a little left behind, and that's a mistake, in my opinion. This is a great time to go value hunting and pick this one up at a discount. Now, most know Qualcomm as making chips for phones, and that's an area that could bounce back in 2025 and 2026. But this company is much more than just handsets. They are expanding into automotive, AI, the Internet of Things, and so much more. The company currently has a market cap of $176 billion, and their stock is up almost 9% in the past 12 months. Now, if there is a cloud over Qualcomm, it's the acquisition of Nuvia, where it resulted in ARM bringing a lawsuit. But it looks like Qualcomm has the upper hand, and once that's settled, I expect investors to jump back into the stock big time, so we want to be ahead of the game. Analysts are very bullish on this stock, with a moderate buy rating and a 12-month price target of around $200, which means you are looking at a 25% upside. And that's not all. Qualcomm has been paying and growing its dividend for over 20 consecutive years. This is the mark of a company that is good for long-term investors. The stock currently yields over 2%. And when it comes to valuation, analysts are looking for the company to generate 11.19 this upcoming year. If we compare that to the stock price, you get a multiple of 14.1. The average is 16.6 times. The stock has been consolidating now for some time and looks like it is ready to go higher. Stock number 5, AMD. All right, let's move to our third stock, and it's one that I mentioned in my top growth stock of 2025, and that company is AMD, or Advanced Micro Devices. This is the year for AMD to shine. We're not looking for them to surpass Nvidia, but they are a clear second-place winner, and their share price isn't reflecting that right now. It's time for them to close the gap, which could pay off big for us. The company has a market cap of $200 billion, but they are down 15% in the past 12 months. That's crazy, because normally you would think that with all the AI hype, semiconductor stocks would be going parabolic. Well, you know what they say you buy when there is blood on the streets. AMD is slated to launch a brand new line of chips for PCs, and as PCs start to rebound, this will be a catalyst. It looks like 2025 will be a huge growth driver for AMD. Analysts are extremely high on this stock, calling it a buy with a 12-month price target of 185. That is a 50% upside from where it is now. Now this is where it gets wild. Analysts say that they will make $5 per share. When you compare that to the price of the stock, you get a multiple of 24.9, which sounds high, but it is well below the 5-year average of 59.4. But we aren't going to focus on that. We instead focus on the PEG ratio, which is under 1, which basically means that you are not paying too much for the growth. Also, if you look at the value of the company compared to its cash flow, EV to EBITDA, it's at 43.8, which is the cheapest it has been in a decade, besides the 2022 market crash. So even though I still love NVIDIA for 2025, AMD looks like a major value buy. So there you have it, folks. 5 stocks that are on my radar heading into February: VICI, Qualcomm, and AMD. Now remember, January can be a bit slow, but February could bring a bit of turbulence, so be prepared. Let me know in the comments down below which of these 5 stocks you would be willing to buy going into 2025. And if you enjoyed this video, be sure to hit that like button, subscribe to the channel, and I will see you in the next one. Take care.